NVIDIA's stock has recently experienced a significant surge, soaring over 9% due to impressive earnings and hitting an all-time high. This remarkable performance by NVIDIA, a leading player in the technology sector, underscores the company's strong market position and investor confidence in its future growth prospects. However, despite NVIDIA's success, the broader market did not share in this upward momentum. The Dow Jones Industrial Average fell over 600 points, and the S&P 500 saw 90% of its stocks decline. This broad-based decline can be attributed primarily to profit-taking behavior following a series of new all-time highs in the market. Profit-taking is a common phenomenon where investors sell off stocks to lock in gains after a period of significant price increases. This behavior can lead to temporary market declines, even in the absence of negative fundamental news. In this case, the impressive performance of NVIDIA was not enough to offset the broader trend of profit-taking, highlighting the complex interplay between individual stock performance and overall market movements. Economic indicators also played a role in shaping market sentiment. The S&P Global Survey of Purchasing Managers, PMI, showed an increase in the composite index from 51.3 to 54.4, indicating perceived economic strength. The PMI is a widely watched indicator that provides insights into the health of the manufacturing and service sectors. A reading above 50 suggests expansion, while a reading below 50 indicates contraction. The increase in the PMI suggests moderate economic growth, which is generally positive for the market. However, the interpretation of the PMI report was nuanced. While the rise to 54.4 indicates growth, there were concerns that this growth might be slowing too rapidly by the end of the first quarter. Employment levels were lower, and while prices increased, they were below the average seen over the past year. This mixed picture suggests that while the economy is growing, there are underlying challenges that could impact future growth prospects. Another important economic indicator is gasoline demand, which is a real-time indicator of consumer activity. Gasoline demand is down 4.5% from the previous year, suggesting slowing growth in the service sector. This decline in gasoline demand hints at a potential peak in the PMI report, as reduced consumer activity could lead to slower economic growth in the coming months. Treasury yields also play a critical role in understanding market movements. There is an inverse relationship between the two-year Treasury yield and stock prices. As the yield rises, stock prices tend to fall, and vice versa. This relationship is driven by investor expectations of Federal Reserve policy. When yields rise, it often signals expectations of tighter monetary policy, which can lead to lower stock prices. In May, the two-year Treasury yield trended down from 5% to 4.71%, leading to a stock market rally. However, recent rebounds in the yield to 4.95% caused a market pullback. This fluctuation in yields reflects changing investor expectations about the future path of interest rates and monetary policy. Fuller, a market analyst, believes that 5% was the peak for this cycle and argues against the likelihood of another rate hike. He views the recent pullback due to rising yields as a buying opportunity in the ongoing bull market. Fuller's perspective highlights the importance of understanding market sentiment and the factors that drive investor behavior. Profit-taking, economic indicators, and Treasury yields all play a role in shaping market movements. By recognizing these factors, investors can better anticipate market corrections and identify buying opportunities during pullbacks. The relationship between economic growth and inflation is also a key consideration for investors. The PMI and gasoline demand provide insights into broader economic trends, but they also highlight the challenges of balancing growth and inflation. While the PMI suggests moderate growth, the decline in gasoline demand hints at potential headwinds for the service sector. This nuanced picture underscores the importance of looking at multiple indicators to gauge the overall health of the economy. The Federal Reserve's monetary policy outlook is another critical factor influencing market sentiment. Fuller believes that the Fed's mention of potential rate hikes is more about managing expectations than actual policy intent. By signaling the possibility of rate hikes, the Fed aims to temper inflation expectations and investor enthusiasm. This approach helps to maintain a balance between supporting economic growth and preventing runaway inflation. In summary, NVIDIA's strong performance did not prevent broader market declines, suggesting that profit-taking behavior played a significant role in recent market movements. Economic indicators like the PMI and gasoline demand provide a nuanced picture of growth and inflation, with mixed signals about the economy's strength. The 2-year Treasury yield is a critical factor in understanding market dynamics, as changes in the yield reflect investor expectations of Fed policy. Fuller's perspective on the monetary policy outlook suggests that the recent pullback due to rising yields could be a buying opportunity in the ongoing bull market. By looking at the data holistically, investors can better gauge the underlying economic trends and make more informed decisions amidst the ongoing balancing act between growth and inflation. Understanding profit-taking and its triggers helps in predicting market corrections, while interpreting economic indicators provides insights into broader economic trends. Recognizing the relationship between Treasury yields and stock prices is crucial for anticipating market movements, and identifying buying opportunities during pullbacks can enhance investment decisions.